Hello and welcome to this episode of The New Normal. Joining me today is one of India's finest fund managers, the very special Navneet Munot, who's the Executive Director and Chief Investment Officer at SBI Mutual Fund. He's been investing for a very long time. He's made a lot of wealth for a lot of people. So we're going to try and understand from him what can we do to make good wealth for ourselves. Thanks very much, Navneet, for joining me here.
Vivek.
It's
Always
great
a
to be in
pleasure
your
to be
office.
with you.
What a lovely office.
Thank you.
And we've talked in different situations, but today we're going to walk and we're going to try and give viewers a reflection of what you are thinking as well as your office. So, Navneet, last 2 months haven't been very good.
Yeah.
And there's been a lot of concern. Have you been getting a lot of phone calls from people?
Of course, and I've been traveling a lot, meeting a lot of investors, meeting a lot of other people. And of course, you are right that over the last few months have been very volatile. People have concerns looking at the economy, at global environment, and of course the markets. Yeah.
So would you say volatility is the new normal? Because we've had, one can't even remember last when we didn't have bouts of volatility like this. Of course, this time round we've seen a sharp fall in the last 2 months, but otherwise, volatility is a new normal as far as fund management is concerned?
I mean, that's a beast one has to learn to live with when you are in markets, particularly in a market like equity market. Why equities deliver such high returns compared to, let's say, a bond or a government bond over a longer period? Because it comes with that additional volatility and the investors get compensated over a longer period. So just give one data point. So, I mean, if you look at last 38 years or so since Sensex started and you have the data for Indian markets, if you invest for a year, there is a 1/3, roughly 31% probability that you can lose money in a one calendar year. But if it is 3 years, that goes down to 14 or 15%. If it is 5 years, then the possibility of you losing money in equity goes down below 10%. If it is 10 years, then there's less than 1% possibility that you lose money. So you need that time period, but intermittent, I mean, you may have this high volatility, which we are witnessing currently.
But has investor behavior changed, Navneet? And I think you and I have been talking about this for at least 10 years. That, will we ever come to a point where people understand this matrix or this data point that you gave? That equity is for the long term, it is volatile, it is not linear. But every time you see a fall, the phone starts ringing. So, but this time round, have you seen any change at all? Because the SIP book seems to be stable. So is that a change you're seeing?
So that's the most heartening part of the mutual fund distribution over the last few years. And as you rightly said that, I mean, there's a typical human tendency. People become greedy when they should be fearful or the other way around. This time, interestingly, and you rightly mentioned that SIP flows have not slowed down. Of course, there are people who are getting fearful, maybe cancelling a little bit of SIP, but I think large number of people this time have stayed put. In fact, I'm seeing another trend where a lot of people are asking, should we increase the SIP? Of course, I mean, as I mentioned that given this higher volatility, people get concerned, but I think they get the message that this is for longer term. And again, talking about the SIP, so what you're trying to achieve in SIP is the averaging over a period of time. So unless you take advantage of the downward movement in the market, how do you get the full advantage of the SIP investing? So I think that that's the most heartening feature, and I'm sure people like you, all the advisors, the industry, everybody deserves credit for that maturity among the investors of how to deal with this higher volatility.
What is the kind of attitude you're seeing with millennials, Navneet? Younger people, I find, are fairly open to taking risk. That's their attitude, that's their behavior, unlike people of our generation who preferred to put money in a bank and were risk averse. The younger generation certainly seems more risk tolerant. So are you seeing a very different mindset and attitude when a 25 to 30-year-old is coming and investing in your fund?
So I call this Zindagi Na Milegi Dobara generation.
Really?
So I mean, they want to experiment, they want to have a different kind of experience. I think the habits of investing are quite different than the previous generation because the risk-taking ability is high. So people in 20s assuming a lot of whether it's a credit card loan or whether it's a mortgage or a car loan or a vacation loan, which maybe the previous generation wouldn't have taken. But on the other side, on the investing side, they have been a little slow, but as you rightly said, they have a risk appetite. Taking loans at that stage just shows that you have a risk appetite. You have a bigger faith in your future. And I'm sure this will reflect in their investing also. They wouldn't be too happy with something, in a bank deposit, which the parents used to have in a small black color bag, some of the fixed deposits and PPF and post office certificates. I think they are more optimistic about future and would like to take some risk. They are a lot more digital savvy. They are a lot more, it's not only about what their money earns, but I think they are also a lot more careful about what their money does to the world. And that's why as a house, we have this huge focus on ESG, environment, social and governance aspects. So they want to see that the future of the planet also is linked with everything they are consuming, what they are wearing, what they are consuming. And I think even in investing, they would be very careful about what their money is doing to the world. So some of these are very interesting aspects about the millennials.
So Navneet, for a 25-year-old who's just starting out to invest, what's the equity mutual fund portfolio that you would recommend?
So my daughter will turn 25 in maybe 2 years' time.
Okay.
Maybe I can think about
what do you do for her? Okay.
Exactly.
That's great.
So
what have you done
think,
for her?
given that if you start early, that's the most important message I would give, because over a longer period, I think the long-term power of compounding will work in your favor if you start at 25 instead of starting at 35 or 45. It makes a huge difference. People know Excel sheet and they can put these numbers in place. Because you have a higher risk appetite, you can start with a much higher allocation to an equity fund. Within the equity fund, I would recommend maybe start with a multi-cap fund, which invests in large caps, mid caps, and small caps. And then over a period of time, as your understanding improves, based on your return expectations, your risk appetite, maybe I think some of the other liquidity needs, etc., that you talked about, the message would be diversify more, stay disciplined, start early, but then ensure that you remain on that path of discipline.
One of the things that we keep saying is that don't look at past performance.
Yeah.
Right? But at the same time, past performance has been quite spectacular for Indian equity.
Absolutely.
If I look at some of the schemes, for example, that you have managed, you've turned in over 20% compounded annual growth over a long period of time.
Yeah.
And I think that somewhere builds expectations in people that even in the next 15, 20 years, we are going to see 18, 20% kind of returns. Is that a very unfair assumption on people? And as a fund manager, if you look at the next 10, 15, 20-year India story, what are the kind of reasonable returns that people can expect from equity fund?
So over the last 27, 28 years or so, India's nominal GDP would have grown at around 13%, corporate profits would have grown at around 14, 15%, and equity market capitalization would have grown at around 16% or so. I feel very optimistic about India for next 25 years. We are still at a very early stage of the growth. But when we look at the expected returns, we have to keep one thing in mind, that in this period, inflation was much higher than what it is today and what it is likely to be. So today we are talking about 3-4% inflation, and an RBI and the government have a commitment to keep inflation at a lower level. Then, so if you have a 4% inflation, you make, let's say, 6-7% in fixed income or a debt mutual fund, that's pretty good return. You are making 2% over the inflation. And then if you make 10-12% on equity, this is a pretty decent real return, because you're building wealth over a longer period by earning that real return. Otherwise, if your inflation is 8% and you're making 12%, that's just 4% real return. Here we are talking about 4% and 10 and 12. I think that's a much, much higher real return. So return expectations have to get moderated in line with the fall in inflation and the interest rates.
So Navneet, given the kind of fall we've seen in the recent past, one is of course the index, which reflects a certain degree of fall, but more than that, if you look at the broader market, if you look at the mid-cap space or the small-cap space, there's been very significant falls in a lot of stocks. How do you read that situation? Are you reading it from the point that there are good companies who are priced very cheap right now? There's a discount on, you can buy some good companies. Or are you seeing it as these were fundamentally damaged companies and that's being shown up right now?
I think a mix of everything. But by and large, I mean, if I look at the broader market today, because we talked about this fear which has gripped the market today, there are now a lot many more opportunities of stock picking than what it was few months back because the prices have come down. Good news and good price are never together because the news is not good. When people are reading something in media, they are watching the TV, the kind of news flow which is there, prices have become more attractive. So actually, because prices have fallen, the companies are more attractive today. Interestingly, in our economics class or in our daily human behavior, when prices go down, we want to buy more, whether it's a t-shirt or mangoes. But in equity market, it's funny.
Opposite.
It's opposite, when there is a sale going on today, people want to be fearful. But it should be other way around. There's very interesting thing Howard Marks has written, if I remember correctly, that when the knife stops falling, when the dust settles, you can be rest assured there won't be any bargain left. So I mean, when there is absolute clarity on the horizon, then bargains won't be left because there is this uncertainty. You are getting good bargains.
So one last question: if I am an SIP holder and Amphi data says the average SIP size is 3,000 rupees, so I'm presuming there are a lot of young people out there who started off. And that's a great thing, as you said, power of compounding. But if I have an SIP going and I say entered about a year ago, I'm seeing negative returns. If I entered about 2 years ago, I'm seeing just about okay. Even up till 3 years back, I'm seeing flat returns. What would you tell someone like that? What would be your conviction statement that if you stay for the next 10, 15 years, you're going to build serious wealth?
Of course, I mean, if you're a 25, 30-year-old, I mean, you're going to live for a much, much longer period. You have to create wealth over a much, much longer period. And I think when markets have fallen, it's good for you when you are an SIP investor. When you are in that accumulation phase of your life, you should be happy that markets have gone down and I'm accumulating more mutual fund units by participating in the SIP. So I think if your finances permit, logically you should increase the amount in SIP, not decrease it, because in last 1 year and 3 years are not looking good. In fact, you go back in history, every time you saw your past returns not so good, it only improves the probability of making better returns going forward. Mean reversion always happens.
Wonderful as always to talk to you, Navneet.
You.
Thank you very much
Pleasure,
for
Vivek.
joining us.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.